welcome to the Schroder Specialist Private Equity Fund update. I'm 𝗏𝗏, and today I'll take you through the recent portfolio performance, composition, a few case studies and outlook going forwards. So first of all, just to touch upon what's occurred in the last couple of years in the private equity universe. You can see from the chart the long-term outperformance of private equity above listed markets. But what we've really seen come to fruition in the last couple of years is the differential between small and mid and large cap has exacerbated. And this is a result of interest rates rising. Interest rate rises have disproportionately affected the larger end of the market as they tend to have more leverage. And as we'll touch upon, small to mid cap companies tend to have lower leverage, so you haven't seen that effect in this part of the market. Just a quick snapshot on our deal sizes. As you can see, we sit squarely in the small to mid cap universe. The median enterprise value of companies we're investing into through our co-investment platform is $323 million and $519 million US for continuation vehicles. Just quickly again, as I mentioned, you can see from the chart on the right-hand side that lower leverage that's experienced in small to mid-cap private equity companies versus larger cap companies. And in fact, in our portfolio, the average leverage of our portfolio is lower than the S&P 500. So we're really looking to drive returns through company growth and what we call the sort of small to mid-cap premium. You can see that from the chart on the left-hand side, which shows the purchase price of small cap companies versus large cap companies. So this is really an exciting feature about the small to mid-cap universe and why you can see that longer term outperformance, because we're able to buy companies at more attractive multiples, then grow, transform, build those companies up, and then someone will pay you a higher multiple for that greater earnings component of those companies. So you really get the double whammy effect once you grow the company, and then someone will pay you a higher multiple of that. So moving on quickly to the portfolio allocation, you can see here as of 31st of August 2025, the bulk of this strategy is sitting in that small to mid buyouts component. We have a couple of little sleeves of venture and growth. You can see from a regional perspective, as usual, a little bit biased towards Europe, but with a large allocation to North America as well, and a small allocation to Asia. By type, again, in line with the fund strategy, you can see 48% of the portfolio sitting in direct co-investments. The other big composition of the portfolio is GP-led deals, or continuation funds as they're also known, sitting at 40%. From a sector perspective, again, heavily allocated towards technology and healthcare. We like those sectors as they're quite resilient. Thinking of things like mission critical technology, services and companies in the healthcare space, again, quite resilient to economic growth, which we like. And then from a vintage perspective, this fund, as you might recall, has been around for about 5.5 years now. So you can see the portfolio has been nicely averaged in throughout those different years of operation. Moving on to performance, for August the fund returned 73 basis points. Calendar year to date we're sitting at 3.23%. It's a little bit lower than average. That's a result of FX has detracted a little bit from the performance of this fund. As a reminder, it's not currency hedged, but you can see still that strong long-term performance of over 15% per annum net since inception. I think importantly as well, just moving on to how have we delivered that performance, this is really interesting. You can see that co-investments have driven the large bulk of returns in this fund, almost over half of the fund's returns. Still, secondaries have contributed really well, and actually our primary fund investments have also contributed quite a lot, especially relative to their weighting in the portfolio. From a geographical perspective as well, interestingly, Europe has been our strongest performer and has outperformed North America, although obviously still some really strong performance from the US and also strong performance from Asia. But I think this is really nice, and again, why the fund quite well complements usually international listed equity exposures, because obviously last year and over the last few years, the Mag 7 has really dominated. So from your listed portfolio, you're probably getting quite strong growth from the US and technology. From our portfolio, you're getting that nice diversifier, that exposure to Europe and exposure to direct companies. Maybe just on to a couple of examples. We've got one here, 𝗵𝗃𝗏. This is a leading ophthalmology clinic platform. Interestingly, this was a little bit of a shorter hold period for us. You can see we only held this company for 2 years. So what the platform, this was a platform acquisition where we bought existing ophthalmology clinics across Czech Republic, Poland and the UK. They then folded up other ophthalmology clinics into the platform, so they entered Slovakia and the Netherlands as new regions. They set up new sites in the UK as well. And what happened here was we actually got an inbound offer from 𝗦𝗽𝗂𝗶𝘃𝗁, the optical eyewear company. They're looking to vertically integrate themselves into the eye testing market, obviously. Then you go get your eyes tested. They're hoping you'll buy a pair of 𝗦𝗽𝗂𝗶𝘃𝗁 glasses if it turns out you need glasses. So we actually, once we got that inbound offer, we put the company up for auction, but 𝗦𝗽𝗂𝗶𝘃𝗁 was the biggest, the highest bidder for this company. So a really good return there. You can see we made a 44% net IRR throughout that 2-year hold period and made 2.2 times our money. And again, what I think is interesting about this exit is it shows again that small to mid-cap part of the market. You're not reliant on IPOs to exit. You're not even reliant on other private equity funds. You've got buyers like this, other corporates who are looking to get access to these really interesting companies that we own. Moving on to another example here, we've got ProfitSolve, which is a payment system solution for legal and accounting professional firms. This was a really strong company. They actually have a higher than 100% client retention rate, which means not only are their clients sticking with them, the clients are actually spending more and more money on their services every year. We like this again, it's quite asset-like, really good recurring revenues from these clients. You can see we managed to double the profitability of the company, exited within 4 years and made 2.4 times our money on that one. So a great example of a tech company that's done exceptionally well. Maybe just one more example. This is a company called 𝗬𝗏. They are a provider of compressed air system solutions to the global maritime industry. So not all private equity is, exciting technology companies. Sometimes you've got these industrial companies that are performing well. We actually bought this through a continuation vehicle, so a secondary investment. Again, company grew. We benefited from the multiple expansion as well. And we made 4.4 times our money in a really short hold period. So that's actually a 60% IRR. So again, a sector that's not really sexy, it's more in that industrial sector, but able to deliver really strong returns for our investors. Maybe just moving on, just wanted to touch a little bit more upon exits because I know there is a lot of headlines about the exit environment for private equity and our companies, able to be sold. This chart just shows the percentage of this fund, this semi-liquid fund, which was launched at the end of 2019, that has been exited every year cumulatively since inception. So you can see we've delivered $310 million of exits since the fund's inception. So again, we've seen good buyers for these companies, despite the fact that there's a lot of, as I said, headlines saying the exit environment is more challenged. Just finally, in terms of outlook, as I mentioned a few times, the fund's been around for over 5 years now. So there is quite a mature and well-diversified portfolio of assets. But the fact that the fund has been growing every single quarter since inception has meant that we're able to make new investments in the fund. So the average age of the companies within the fund is only 2 years old, so relatively young. You can see about 70% of the assets are sitting quite early in their value creation journey, so sitting at between 0.9 and 1.5 times cost. On our average, our team's track record is delivering 2.2 to 2.8 times cost. So you can see these companies should have a lot of value to generate as they continue to grow, continue to execute their value creation plan, whether that's through M&A, through expansion into new geographies, whatever the plan is for that company, should continue to see growth. And then pleasingly as well, we've got about just shy of 20% of the portfolio sitting up above 2 times cost. So these are really good exit candidates as well, which is important obviously for a semi-liquid fund. You want to have young companies that can continue to deliver returns for investors, and also more mature companies that are ready to exit if we were to have any liquidity, any redemption requests within the fund. So just in summary, I think the semi-liquid fund really gives you access to what we think is the most attractive segment of the private equity universe. That's that small to mid-cap part of the universe, a very fragmented part with lots of opportunities. The team, obviously, it's a well-established fund. We're one of the few funds in the market with a track record of over 5 years, and the team have a 28-year track record in the market, delivered obviously a 15.4% net since inception. The portfolio is very well diversified today. You've got about 90 companies making up 90% of the AUM, but 290 companies in total. And then obviously you've got that attractive liquidity profile with the ability to invest on a monthly basis and then redeem on a quarterly basis. And obviously the fund's available on all the major wrap platforms. Thank you.